All right. So today we're gonna dive into a really interesting investment strategy
Yeah.
called coffee can investing.
Mm-hmm.
And this is based on a book,
Right.
the same title,
Yeah.
by Mukherjea, Ranjan, and Uniyal.
Yeah, those guys.
Um, and our goal is to really understand and unpack this idea
Sure.
of a low risk way to potentially build significant wealth.
Absolutely. And you know, the
Yeah.
the idea is deceptively simple, right?
Sure.
You buy a portfolio of really high quality stocks,
Right.
and then you just hold them for a long time, like a decade,
Yeah, untouched.
untouched. It's like a
The name coffee can investing is a great analogy, right?
Yeah, where does that come from?
So it actually comes from, back in the Wild West.
Oh, really?
People used to keep their valuables in a coffee can,
Right.
and bury it
Right.
and just leave it there. So it's this idea of just leaving it alone.
Yeah, it's not about like the
Right.
picking the perfect coffee can.
No.
It's like put it in something and then just like forget about it.
Exactly.
Exactly.
And it's funny because this isn't, this whole idea
right.
isn't like some, invention by these authors.
No.
It's based on this observation.
This is an observation by this guy, Robert Kirby.
Okay.
Now, he was an investment manager, I think,
Okay.
and he noticed this really interesting thing with one of his clients.
Uh-huh.
The client's husband had this habit of just buying stocks
Okay.
based on tips and recommendations from friends and brokers and whoever, right?
Yeah, like hot stock tips.
Exactly. But he never, ever sold, like literally never sold any of his stocks.
Wow.
And guess what this complete inactivity led to?
What?
Well, the guy ended up becoming incredibly wealthy.
Just by not selling?
Just by not selling, just by holding on.
That's amazing.
It is amazing, isn't it?
It's like the opposite of what you hear.
It is. It's so counterintuitive.
Yeah, you always hear about
That's-
people timing the market and
Buying low, selling high.
yeah, exactly.
All of that.
And this guy just bought and held forever.
Yeah, and it goes to show, sometimes the best thing you can do is just do nothing.
Right.
Especially when you've picked good companies to begin with.
So it sounds like this coffee can investing strategy really boils down to answering two fundamental questions about investing.
You got it.
What stocks to buy
Yeah.
and how long to hold them.
For how long, right? And the book does a good job of using these stories
Right.
of two individuals, Mr. Talwar and Mr. Singhvi.
Okay, yeah. What can we learn from their experiences?
I think their stories are cautionary tales, really.
Okay.
They highlight the dangers of chasing quick returns and not having a clear investment plan.
Okay.
Mr. Talwar, for instance, he got burned by missold financial products,
Right.
things like ULPs, which are these insurance cum investment schemes.
Right.
And he also dabbled in trading stocks based on, gossip and rumors.
Yeah, I've heard those hot stock tips too.
Yeah, and ended up with a very low return over, several decades.
Ouch.
Yeah. Mr. Sanghvi, on the other hand, he was a much more aggressive trader.
Oh, okay.
He got into futures and options, leverage positions, even lending money in the informal market.
Right.
And that nearly led him to bankruptcy.
Oh, wow.
So these examples really highlight some of the common pitfalls that investors fall into.
Like what kinds of things?
Well, not having a clear investment objective, trading, too much lack of diversification,
Right.
getting caught up in high fees, chasing short-term returns,
Yeah.
trying to time the market, ignoring inflation and taxes, these kinds of things.
So basically all the classic mistakes.
Pretty much, yeah.
So how does the coffee can approach help us avoid these traps?
So coffee can investing is all about focusing on companies that have this durable competitive advantage.
Okay.
What Warren Buffett calls a moat, like a company like, let's say, Asian Paints.
Okay. Yeah.
This incredible brand name and its huge distribution network.
Right. Makes sense.
You want companies that have these enduring moats.
Enduring moats.
Yes, in stable industries. And the idea is to hold these companies for a very long time.
Okay.
Like forever, if the business and management are exceptional.
So essentially it's saying find a really great company and just stick with it.
Exactly.
And it'll grow over time.
That's the idea. It's a simple concept, but the difficult part is actually sticking to it.
Right. I could see that.
It's about trusting the management
Okay.
and their ability to allocate capital well and letting your successful positions run for the long term.
That's interesting because it takes like all the emotion out of it.
It does. It does.
Yeah, it's like you're not
You're not constantly checking the stock price.
exactly.
You're not worried about the daily ups and downs. You're focused on the long term.
Yeah, it makes sense. So, okay, so let's say I buy into this idea.
Okay.
How do I actually go about picking these coffee can stocks?
Right. So the book recommends some simple filters that you can use to identify these high-quality companies. So for starters, you want companies with a minimum market capitalization.
Okay.
So let's say 100 crore rupees.
All right.
And then you want to look at their sales growth. They should have grown their sales by at least 10%
Every year.
every year for the last 10 years.
Wow, okay.
And the third thing is their return on capital employed,
Okay.
which basically tells you how well they're using their money,
Right.
and that should be at least 15%.
So basically like how efficient,
They are. Yeah, okay.
exactly how efficient they are at generating returns.
Okay, and what about companies in the financial sector?
Right. So for financial firms, you would look at their return on equity,
ROE.
ROE exactly.
Okay.
And also their loan growth, which again should be at least 15%.
So it sounds like a lot of these filters are about consistency,
Absolutely.
like showing that track record.
Yeah, you want companies that have a proven track record of performance
Right.
over a long period of time.
Okay, so has this coffee pen approach actually been tested? It has actually. The book presents backtesting data going all the way back to 1991.
Wow.
And the results are quite compelling, I have to say.
Okay, tell me more.
Well, it turns out that this approach has consistently outperformed the benchmarks across different time periods, even during market downturns like the 2008 crisis.
Wow. Yeah.
And what's even more interesting is that over a 10-year period, the median outperformance was pretty significant.
How much?
Around 11.9% per year.
Wow, that's huge.
It is, and also what we see is that the volatility of returns tends to be lower
Okay.
over longer holding periods.
So it's kind of like smoothing out
The ride, exactly.
the ups and downs.
Exactly.
Yeah. So I guess that makes a lot of sense given the fact that you're holding these companies for so long.
You're not reacting to the short-term noise.
So you're saying this long-term buy and hold strategy works.
It seems to work, yeah.
But why does it work so well?
Well, I think the fundamental reason is that earnings are the biggest driver of long-term stock returns.
Earnings.
Yeah, if you invest in companies that can grow their earnings consistently,
Okay.
and they're doing it by using their capital efficiently,
Okay.
their share price will tend to follow suit.
So the share price is really just a reflection
It's a reflection of the underlying business performance.
of how well the company is actually doing.
Exactly.
Right.
And the book has a great example of this with Page Industries,
Okay.
which is the maker of Jockey Innerwear.
Okay. Yeah, I know.
Yeah, so they've consistently grown their revenue, more than 10% every year, and they have a very high return on capital employed over 15% for the last 15 years.
Consistently,
right. And their share price has gone up dramatically.
Wow.
Driven primarily by that earnings growth.
Interesting. And this whole idea of like not churning your portfolio.
Yes.
Like, why is that so important?
Well, a lot of people think that they need to be constantly buying and selling to make money in the stock market.
Yeah.
But the reality is that frequent trading often ends up being a wealth destroyer.
Really? How so?
Well, first of all, you have transaction costs.
Right.
Every time you buy or sell stock, you're paying brokerage fees, taxes, and so on.
Yeah, that adds up.
It does add up, and the more you trade, the more you lose to these costs.
Right.
And secondly, trying to time the market is incredibly difficult.
No, it is.
Nobody can consistently predict when the market is going to go up or down, especially with these high-quality companies that tend to outperform over the long term.
Yeah, you probably end up selling.
You end up selling too early.
Yeah.
At the wrong time. Yeah.
So it's best to just hold on and let the power of compounding work its magic.
Yeah, because I guess even if you have like
Right.
a 50% hit rate, if you're holding for the long term,
Should be good.
and some of those companies are like really big winners.
The winners will dominate. They'll make up for the losers.
Absolutely.
Interesting. So it's really about like neutralizing the market noise.
That's a great way to put it, yeah.
Yes, you're not like emotionally reacting to like every little blip.
To every little blip, yeah. You're focused on the big picture,
Right.
the long-term growth story of the company.
So earlier we talked about finding good companies with a good track record.
Right.
What about valuations? Does that matter?
That's a great question. And what's interesting is that the book's research suggests that starting valuations in India actually have a very limited impact on long-term returns.
Really?
Yeah, especially for these high-quality companies.
Oh.
So trying to time the market by waiting for the perfect entry point or selling because you think the valuations are too high can actually lead you to miss out on a lot of the gains.
So it's kind of like you're paying a premium.
You could say that, yeah.
But it's worth it because of the growth.
Because of the long-term growth potential.
Interesting. So is there anything, are there any commonalities between these coffee can stocks?
Yeah, there are some interesting patterns.
Okay.
So you'll notice that a lot of them tend to be in business to consumer sectors.
B2C.
B2C, exactly.
Okay.
And they're more structural growth stories than cyclical ones.
What do you mean by that?
So structural growth stories are companies that are benefiting from long-term trends, like rising incomes or changing consumer preferences, whereas cyclical companies are more tied to the ups and downs of the economy.
Got it.
So coffee can portfolios tend to skew towards these more stable structural growth companies.
Makes sense. And I guess they're also the kind of companies that are less likely to take on a lot of debt.
That's right. They're typically companies that are not borrowing heavily to grow.
Okay.
They're funding their growth from their own profits.
Right.
And they often have these intangible strategic assets.
Like what?
Things like brand power, strong distribution networks, proprietary technology, intellectual property.
Okay, so kind of like those moats that we were talking about earlier.
Exactly, those moats, those competitive advantages.
And is there I know you can't give specific financial advice.
Right.
But is there a sample coffee can portfolio?
Yeah, so the book has an example portfolio for 2017.
Okay.
And it includes names like Asian Paints, HDFC, Bank, Nestle.
Okay, big names.
Yeah, these are all high-quality businesses that you would ideally invest in equally and then leave untouched for 10 years.
So it's like diversification.
Yeah, diversification and just letting them do their thing.
So I guess if we had to distill the core message of coffee can investing, what would it be?
I think it's about identifying quality and then having the patience to let it work over the long term.
Patience being the key word.
Patience is key, yeah. It's about ignoring the noise and not getting distracted by the short-term fluctuations.
And not overthinking it.
Not overthinking it, exactly. Yeah. It's about trusting in the power of compounding in these great businesses.
Yeah, so it's not really about stock picking skill.
It's not about being the smartest guy in the room.
Yeah, it's more about finding these strong companies.
Yeah, finding these enduring businesses.
And just sticking with them.
And sticking with them through thick and thin.
So let's quickly recap some of the key takeaways. Okay. So number 1, avoid excessive trading and high fees.
Absolutely.
Number 2, focus on a long-term buy and hold strategy.
With quality companies.
With quality companies.
Yes.
And number 3, the historical data seems to support the coffee can approach.
It does. It does.
Yeah, it's pretty interesting.
It's a powerful concept.
So I guess the question for our listeners is, can you adopt this level of patience and trust in quality to potentially transform your investment journey?
And do you have the discipline to really leave that coffee can untouched?
Yeah, could you just set it and forget it?
Exactly.
Well, that's a great place to end it. Thanks for diving deep with us.
It was a pleasure. Thanks for having me.
And we'll see you next time.
See you later.
Bye.